Jan VanEck, CEO of VanEck Funds, one of the world's largest ETF sponsors. It is so great to welcome you to the show. Great to have you on.
An honor to be here, Julia.
Well, I'm really excited to talk to you, Jan, and especially as someone who's kind of known for identifying some macro themes and trends over the years. So I was hoping maybe we could just kind of start with your overall macro picture today, and then we can kind of start to zoom in on some of the themes that might come up.
Sure. Maybe if I could just explain what I mean by macro a little bit by context, which is simply two, I would say, premises. Number one, that the financial markets really are in part of an ecosystem that's affected by the economy, obviously, politics, and technology. So there are things outside that are happening and changing outside the world that suggest what you should be invested in, such as what asset classes. For example, the rise of China and emerging markets led to the inclusion of emerging markets in your portfolio, whereas before that, it wasn't in there. And that's the same for gold and commodities during different cycles as well. So that's what I mean by macro. The other aspect of macro that we like to point out is how rapidly the world can change. A little bit of a historical background. And our firm was founded, my father started the firm and is best known for starting the first gold fund in 1968. Gold had been fixed against the US dollar for 170 years. And he said, that's going to change, and it's going to change dramatically. And it did in the 1970s when gold went from $35 to $800 an ounce. So sorry for all the background, but that's what I think about as far as macro. Should I talk about where we are now in a couple sentences?
Yeah, go for it. Let's do it.
I think 2022 can be summarized actually in one sentence. The Fed raised rates. Interest rates went up. That drove bond prices down, and it drove stock PE ratios, what we call multiples, down to adjust for that rise in rates. And that's really it. The world economy was fine. The US economy was fine. Unemployment is low. But the Fed really changed the calculus of what financial assets should be priced at. I think that's largely done, that rate increase cycle. So now investors are offered really attractive interest rates, I think, for some kinds of fixed income. And fixed income can and should be a lot bigger part of people's portfolios than it was a year ago.
Let's talk about, like, what do you mean, like, fixed income should be a bigger part? Because I think often folks talk about, the 60-40 portfolio. Are you talking about, like, kind of rethinking that kind of construct?
Yeah, I mean, we talk about 60-40. In our industry, listen, we have to provide retirement solutions for millions of Americans, but there's absolutely no support for 60-40. 60-40 is just a point in time, people's estimates based on backward-looking volatility of stocks and bonds. And I more care about what my returns are going to be looking like going forward, and I think more about total return. And there are periods of time where fixed income and high yield in particular have outperformed equities, and so. You have to pivot around something, but I would be majority weighted in fixed income right now and throw the kind of 60-40 rubric out the window.
Real quick follow-on. Do you think 60-40 is dead? Is it outdated? Was that just a different time?
Well, like I say, our industry has to provide investment solutions, retirement solutions, right? Because we do our own retirement through the 401k programs and things like that. So you have to have a rule of thumb. I'm just pointing out that rule of thumb has really no academic support. And as shown in this year, it can be pretty unreliable. So that's why I tend to start with what is your macro outlook? But no, to answer your question, I don't think our industry really can move away from it because, what people call market timing or tactical moves between fixed income and equities, no one really has a great track record in that. So that's the issue from an industry perspective.
Mm-hmm. And going back to your point about fixed income looking like much more attractive, like, so it sounds to me like that's somewhere like you would want to deploy capital. Where within the universe of fixed income, like what is attractive to you in that universe?
So going into next year, my base case, and I'm happy to go into details, is that the economy is going to be okay. Maybe it slows a little bit. I don't see a deep recession right now. And I think corporate earnings won't do that well. So in that environment, I'm generally okay to own all kinds of fixed income because I don't think if you don't get a deep recession, then default risks for high yield aren't going to increase. So the 8% or so that you're getting now on high yield is pretty attractive. What I do worry about a little bit, not to get too technical, but is the longer duration fixed income, because short-term interest rates are higher than long-term, but we don't see inflation going below 3% next year. So I think long-term fixed income investors are going to say, well, wait a minute, if inflation is 3%, I want to get paid more than that. I got to get paid a real rate of return. And I'm not sure, 3.75%, which is what you get now, is really going to be enough. So I guess I'd stay a little bit shorter term, but overall, I'd put more than 50% of my portfolio in fixed income from a total return perspective.
Mm-hmm. When you say duration, is that like interest rate sensitivity? I'm not a bond investor, so I don't know the vernacular per se, but.
Yeah, that's exactly right. It's sort of like, short term is the 2-year and long term is the 10-year or the 30-year. And interest rate changes have a much bigger effect on your on the bond price the further you go out. So so that's why stay shorter term in your fixed income.
Got it. That makes sense.
But I would buy corporates and all converts and all kinds of different, maybe even dividend equities, because I'm not really worried about a recession.
Yeah. Well, Jan, what I love about hosting this podcast is I have so many different conversations and different viewpoints, and I think that's really helpful for the audience too. And I've had a number of folks who've been very bearish and thinking we're going to have a long, protracted recession, and I'm not hearing that from you. So walk me through like how you get to your thesis, or what is it that's making you a bit more optimistic about the state of the economy? What are you looking at?
Well, I mean, from a fixed income perspective, I guess when I hear deep recession, I just want to know who can't pay me back on my bonds. So let's start with the municipal bond market. States and municipalities, especially investment grade, but they rarely default. So you'd have to have some kind of really bad cycle for default rates in investment grade municipals to increase. And then take corporate high yield. So U.S. corporations are in really good financial position. They've borrowed money at very low interest rates, kind of over the last several years, and they're not very leveraged. So it would take a lot of economic damage, I think, to cause default rates to go high. So let me use some numbers, if you will. If you put $100 in high yield bonds, at the high end, 5% might default, and then you still get some money back. So it's not like the high yield company defaults and goes to zero. So let's say that 5 cents out of your dollar defaults, but you get half of that back. So you've only lost 2.5% on that from a total return perspective. I think at 8% interest rates for high yield, you're getting paid to absorb that 2.5% risk, right? It goes 8 minus 2.5 is 5.5, right? So you've got that cushion. I think 5.5% is not bad return in that bad case. That's why those talking heads don't freak me out too much.
Mm-hmm. How about what's your kind of thought or outlook on equities?
I think equities, so we've had this reset in interest rates, and I don't think that earnings, we just had a really great third quarter earnings, I would say very solid, given that people were really worried about the economy. You've got one sector in trouble, which is obviously real estate, which is highly dependent on interest rates, and that's going to slow. Let's call that in a recession. But for the market overall, I see earnings being fine. But I don't see the impetus for a lot of increase in profits next year, which is why, again, I kind of prefer fixed income over equities.
Mm-hmm. When we were talking about fixed income, you also brought up inflation, and I mean that seems to be like the topic, everywhere these days. What is your thought process for inflation or your outlook there? And do you think? Well, I'll ask you some other follow-on questions to it, but let's just kind of start there.
Sure. So let's just talk about inflation first of all, because I think a lot of data that we talk about in the financial press are misleading. The U.S. economy is generally a services economy. What drives inflation is wage expectations. So I know we talk a lot about gas prices at the pump and OPEC and this and that and the other thing, and that may affect our thinking about inflation. But at the end of the day, and we have supply chain shortages and ag prices, but all that stuff gets solved in a matter of time. The market will plant more corn globally, and we can respond to other kind of shorter term issues. But what really matters are inflation expectations in the labor market. The labor market is very tight. And so that's what makes me worried about inflation going forward. And that's why I don't think it'll fall off it won't go back to 2% next year. So that's really what we're looking at. The problem, Julia, is that it's very hard to know what is going on with the labor market. I mean, here we are in November of 2022, and unemployment is still near all-time lows, right? So the Fed has been raising rates or talking about raising rates for a full year, and nothing has happened yet to the labor market. And I think, also don't know what the COVID effects are on people's desire to work and to go back to work. So there's not a ton of visibility there. But that's what I think you need to look at. And the last point I would make is that services inflation really accelerated. Again, people aren't paying attention to this, but accelerated over the summer, whereas some commodity prices were going down. So I think inflation, that's what to look for in inflation, and I think it'll be more persistent maybe than people think. Having said that, commodities I think are going to be well supported because China seems to be sort of moving beyond COVID, and they have been historically a big driver of the world economy. So I think commodities are going to be a good investment. It's just that they aren't really what matters to persistent inflation.
Got it. So do you think the 2% inflation target, is it just kind of unrealistic?
Don't you think so?
I'm asking if you think so.
Yeah, I mean, I just think that, again, given that the labor market hasn't weakened that much, I don't see it falling. I think people still I think that inflationary psychology is still out there. So it will fall, no doubt. Mathematically, we know that, but whether it'll get to 2% next year, I doubt it.
Yeah. I just want to bring up an idea because this came up on 2 episodes ago. So this was like the Danielle DiMartino Booth episode for folks watching and listening. And she brought up a point, and I'd love to get kind of your reaction. And I'm totally paraphrasing here, but one of the things about labor right now is you've had a lot of layoffs in Silicon Valley, for example. But a lot of folks, there's more like white collar jobs, and there's a lot of severance there. So maybe there could be a lag. Do you think that might be a factor?
Yes, absolutely. Well, a couple of factors, right? And that's why I'm saying it's kind of amazing in November of 2022 that we don't have more visibility on the labor market, right? But the stimulus checks really fatten people's bank accounts, so they have a lot more runway than they would in a normal Fed tightening cycle. So that I think is one of the reasons. And so you've got multiple factors going on besides the ones you mentioned.
Mm-hmm. You also brought up commodities, and you mentioned like the pioneering work that your father did. I think 1968 had the first gold fund. Is that right? Okay. Yeah. And from what I understand from reading, you were also very early to ETFs on the gold side of things in like 2006. You can correct the record here, but I want to hear more on your thoughts on commodities, just kind of given the history of the firm and how you all have been able to spot and identify trends. Yeah.
Listen, I've been saying for a year, commodity equities in particular are a great investment, and I still think a lot more people are saying that now, that since they were the top performing sector in equities this year. But the way I look at it is we actually have a multi-year energy transition investable trend, if you will. What do I mean by that? We want to move towards a lower carbon future, and that affects demand for metals and lots of different commodities, as you know. And so there's going to be government policies and consumer behavior that will change demand for solar, wind, renewables, battery storage, what we call green metals, lots of different things. And we think that that's really underpinning, regardless of the short-term Fed cycle, that's a multi-year investable trend, combined with the fact that a lot of these companies are very low price to earnings ratios. And the reason for that is investors are skeptical. We had a full decade, basically, of a bear market in commodities during the 2000s. And a lot of companies had to cut CapEx, cut employment. Oil companies are very disciplined. Mining companies are very disciplined. And so they're cheap. You've got, I think, a good demand story. And you've also got supply constraints because it's hard to radically increase oil production or metals production. So that's that's sort of a structural support trend, I think, that we're at right now.
Yeah. We've mentioned some ideas like where you might want to be putting capital work. What are the places that you're like just kind of avoiding, just not the right time right now, or just not the right environment?
Listen, I think that there's very few things that are radically mispriced in the market. Like sometimes there are, like a year ago, growth stocks were obviously way overvalued. You had private venture capital deals going at 40 or 50 times revenue. So I don't think there's anything that extreme. Like I was saying before, I'd want to stay a little bit shorter in my fixed income portfolio. But I think a lot of these risks, like sanctions risk vis-a-vis China, have been priced in. So the thing is, I think, Julia, what people are still a little bit too focused on the next equity rally. And I think that's why people are really going to underinvest in fixed income. I guess that's my big overarching theme. And let me just give you a statistic. So we're in an inflationary cycle. In the 1970s, if you look at stocks and bonds actually, even in the, inflation is supposed to hurt bond prices, and it does, but still bonds outperformed stocks during that time period. And there's other time periods where high yield bonds will outperform stocks. So if I guess I had one kind of thing to say, stay away from, put away your trigger finger from always your inclination is to buy more stocks. And look at some of the value in bonds. I know it's been a horrible year for bonds, but that's kind of my thought. Don't over chase equities.
Yeah, and hasn't it been it's been a bad year for bonds and stocks though? That's not.
No, it's been a horrible year, but that means a lot of value creation in bonds. That's kind of
interesting. Okay, so you point out that a lot of folks are probably too focused on the next equity rally. Let me ask you this: Is it because they're expecting, the Fed put, if you will, or Fed to, I don't know, do something where it makes it more attractive to be in stocks again?
Exactly. I mean, that's all what we're focused on, right? It's like the question, very few, like on CNBC, right? They don't say, hey, are you really going to get 8%? You can get 8% in high yield. Are you really going to get that in equities next year? No, they're always like, oh, is the Fed pivoting? What's the next interest rate going to be? When's the last one going to be? So I can jump more into equities. Like, okay, but look at fixed income. Maybe it's not as exciting to talk about, but I think, you get a lot less volatility and you get this compounding effect. That's why bonds did so well in the 70s and during other time periods, because if you're getting paid 8%, that compounds. At the end of a 12-month period, you invest $100, you have $108, and then you get the 8% on the $108, right? So that's why, that's really why fixed income can be, is an underappreciated part of people's portfolios.
Interesting. Would you want to pick your spots in high yield? Like, I'm just wondering if maybe during the pandemic with some of the stimulus or whatnot, like some companies that maybe should have been zombies were propped up. I don't know, like I'm not the expert in the space, but you probably want to be careful, right? Picking your spot within a high yield. I don't know.
I guess, it's hard to say. I would say obviously real estate's in a recession, but the market is so good at pricing these things in that those investments already have gone down a lot. So, as I said before, I'm not really sure anything is particularly mispriced at this point in time. I think that we have, like, for example, a fallen angel high yield ETF that focuses more on, let's call it double Bs. So it's a little bit higher in credit quality. But even that, I wouldn't necessarily overweight at this point. I'd go for broader high yield as well. I really think that you're not seeing those credit downgrades that come with a recession yet. That's a little bit more of a lagging indicator, and I'm just not seeing that level of distress right now.
Gotcha. You also mentioned like bonds did well. They outperformed in the 1970s. And one of the things I kind of noticed about you, Jan, on your website for folks watching, and you can fill them, you have a lot of videos on kind of financial market economic history, if you will. A lot of these videos, I didn't have time to watch them all. I was watching part of one before we started this. And so it seems to me that you look at history. How do you kind of analogize? I know things rhyme. They don't always repeat themselves, but how do you kind of analogize the period that we're in if you kind of look back through history? Because you did mention the 1970s. Is that kind of what you see?
So, history doesn't, like, I don't have a base case in history. I think that's kind of what I say is use history to identify all the potential outcomes. And only after you've done that should you say, what's the likelihood, right? So go to the Russian invasion of Ukraine. People are like, that's not going to happen. Well, of course, it's a possibility, right? And it should be priced in. So a lot of the 2023 outlook to me depends on the Fed. The Fed right now has a lot of credibility. So what I was talking about, investing in fixed income, that is aligned with the thesis that the Fed will retain the market's respect, if you will, and be a little bit maybe more aggressive than the market would like, but the market will still believe that the Fed is sort of, if you will, in control. The alternative scenario of the 1970s is when people very much lost faith in the Fed. And then gold and commodities, and I would say this cycle, Bitcoin will do really well. So right now, Julia, I think we'd have to get together again in probably a year or two. So let's say that we do hit a recessionary time period, maybe, as I said, in a year or two. Will the market be concerned that the Fed is too soft and will start cutting rates too much and lose its discipline on inflation? And that's a good scenario for stores of value like gold and Bitcoin. But right now we're not there. We're almost at peak Fed credibility. So that's when you want to own fixed income.
Peak Fed credibility and why you want to own fixed income. Can we just dig a little, like double click a little bit more on, on the Fed? And you mentioned almost like peak Fed credibility. Is it because they're not? I don't know how to ask it. Is it because they're not so worried about what the market is doing? I just want to hear your thoughts on kind of what the Fed's been doing. And
the market will react, right? I mean, you have Fed governors talking. I heard today one of them talked about maybe 7% short-term interest rates. I mean, that they're not scared of, they're not. During the last decade, when we were we had a financial crisis. Our banks needed to make profits so that they could have more equity, so we could have a safer financial system. And the Fed kept interest rates super low, and they wanted the financial markets to be high in that environment. Now that Fed is basically saying, I don't care about the price of this, what's happening in the stock market or the bond market. I'm going to kill inflation. I'm going to raise rates. And so, and frankly, I think they probably are going into their Thanksgiving celebration saying, job well done. I mean, so far, nothing is broken in the financial, prices are down, but nothing is broken. There haven't been bouts of illiquidity. It's been a pretty orderly year so far in the financial market. So I think the Fed is pretty happy, and they're not going to give up now, right? Powell is going to make sure that he slays inflation. That's, he doesn't, he's like the Paul Volcker poster on his wall or something. So That's what I mean by the Fed peak credibility. And they're willing to almost make a policy mistake on the other side by over tightening.
Yeah.
So again, that's okay for fixed income investors.
Yeah. I'm wondering too, like, I'm a millennial, so I came of age right around the financial crisis, like graduated a couple years after. But I wonder if it creates like an opportunity too for like kind of newer investors to get in at more attractive valuations. So
Yeah, of course. Of course. I mean, I think the only thing is it's unlikely to me that you're going to have this incredible fall in interest rates like we did over the last 40 years, right? When interest rates, the 10-year went from 20% down to 1%. I mean, that is such a tailwind for stock and bond prices. And so, yes, entry points today are cheaper, but I'm not sure you get that, that kind of artificial lift, if you will, by interest rates going back down towards 1%.
True. Yeah. I missed that one. I guess I didn't have any money when I graduated to play along. You mentioned gold and Bitcoin, and I do want to talk about those asset classes. I think maybe like right now, the FTX fiasco that's playing out. What are your thoughts on that?
We don't have enough time, but I think I would just call FTX one of the last shoes to drop in the whole deleveraging of the crypto space. And what we saw, a lot of business practices in crypto were really hyping up new tokens and using various business practices to kind of stimulate growth and token adoption. And by token prices going up, that would bring more attention to the software project. And people just went too far. And the analogy I use is what FTX had a lot of small cap stocks on their balance sheet, which is fine. They made a lot of money in them, great. But they borrowed against it. And you just don't borrow against small cap stocks because they're, number one, very volatile, so they can go down super fast. And then also they can be hard or impossible to sell. And that's really, this FTX bankruptcy last week is really, I think, was started in Q2 through the Luna Terra, and it's just taken a long time and probably some unethical practices on their behalf to lengthen the time that they had before they declared bankruptcy.
Yeah. What do you think are like some of the more near-term effects? Like, does this impact like institutional adoption of Bitcoin? Like, what do you think are some of the more knock-on effects of this?
I do think so. Most of the institutions, like the endowments and pension funds I talk to, actually don't buy Bitcoin or Ethereum. They invest in venture capital funds. And what we saw is some very prominent venture capital funds invested in FTX. And we also know that they ended up not just owning companies, like most venture capital firms, but also some of these tokens. And they just didn't do a good job of managing their token exposure. So I think that is, I think institutional investors are going to be saying, is venture capital really the way we want to get access to the opportunities of blockchain and Ethereum? So that's one thing. We offer a liquid token strategy, which is more diversified, more liquid, I think, and therefore better risk managed than venture capital. So I will say I'm talking my book a little bit. Can I just say something positive about the crypto future? Because people are very skeptical about it. I will say that the good news for investors is that the leverage is out of the system. And I think that in the summer of next year, 2023, Bitcoin goes through what they call these halvening cycles, where it's harder to mine Bitcoin. And the next one is in 2024. So I think in the second half of 2023, investors will start looking at, maybe it's time to buy some. So we'll see if there are any investors left in crypto, but I would say that cycle should be positive next year.
Yeah.
And at that time, right, the Fed will have done raising rates, and they won't be tightening. Maybe they'll still have credibility, to stick with that theme, but they're probably done tightening. So it might be a good time.
Yeah, no, it's an interesting point too. Like talking about just get the leverage out of the system there, and you help me understand like when you first got into Bitcoin or digital assets. I think it was 2017. Like what was it for you that was piqued your interest or was attractive from an investment perspective?
Sure. So, I think as investors, we always have to like look out for new technology. So Bitcoin and crypto is certainly on my radar screen. But I think for some reason in 2027, I said, wow, I'm also, I'm a CEO, I'm a business person, and gold funds, as we talked about, is one of the things that we're a leader in. So I'm afraid of disruption, right? If you want to say that our ETF business helped disrupt active management, I didn't want something else to come around like Bitcoin and disrupt our gold business. And so that's why I hit the books and listened to the podcast and really tried to educate myself. And I said, look, I actually think this will appeal to a lot of investors. And I think maybe that was a minority view in early 2017, but I think that's definitely proven to be the case now. Even where the Bitcoin price is now, it's up many multiples from there, and we've seen tens of millions of Americans buy Bitcoin on Coinbase and Gemini and other exchanges. So that's what led me to Bitcoin paranoia.
Yeah, how do y'all like help me understand like how do you guys help folks access the asset, or like how does it work? Like from if someone's interested in Bitcoin, like how do you all express that interest?
Yeah, very simply, we have an ETF in the United States that tracks Bitcoin futures, and we have an ETN in Europe that tracks Bitcoin. So that's the most easily accessed vehicle right now. I could again talk for a long time about regulation and what's available and what's not available, but that's what you can get now.
Got it. So that's like a futures ETF. I know I'm not a full expert in this space by any means. Didn't folks want a spot ETF? Wasn't that one of the things people have been pushing for?
Yeah. Let me explain why. So all commodity funds and ETFs that are out there, they don't actually buy the commodity, generally speaking, except for gold. Right? They're not buying oil barrels and putting them in a bank somewhere. They're investing in the futures curve. And the futures curve can be very different in terms of performance than the underlying commodities, which we find is very confusing to investors. And part of our job is to simplify things and meet investor expectations. We don't know what the future holds, but at least the funds should perform in line with their expectations. And we know from the commodities world that the futures market can distort prices a lot. In 2006, I think, because of the shape of the futures curve, crude oil funds underperformed the price of crude oil, spot crude, by 20%. I mean, when someone buys an oil fund and it underperforms by 20%, you're going to get disappointed investors. So the reason people want spot Bitcoin ETF is because they don't want the effect of the futures curve on the price. Now, actually, since these funds came out, they've done a really good job of tracking Bitcoin. So maybe it won't be, since it's a financial asset, it won't be as different from spot, but that's why people want spot, because of the risk that the futures curve can change the performance.
Do you think we'll see a spot ETF at any point? Or in the near term?
Right now, especially with FTX, and I do advise our local New York State crypto regulator. So not that persuades me one way or the other, but I think Washington, D.C., and we do work with the SEC a lot through our ETF business, is still very confused as to which direction they want to go, partially because of the complexity of the subject, and partially because we have overlapping regulatory agencies. The commodities regulator, the securities regulator, and the banking regulators are all looking at crypto, and think they have some jurisdiction. So it's kind of frozen right now, and so I don't see a change to that anytime soon.
Mm-hmm. It seems to me like you've been at the forefront of like recognizing disruptive forces, like starting the gold ETF in 2006, and I think it's kind of steeped in the history of the firm too, and recognizing digital assets in 2017. How like I want to kind of zoom in a bit more on the thesis. Like, do you see it as like as a form of digital gold? Because you mentioned like it was at the time you were seeing it like as a competitor to gold, and that's why you wanted to do your research.
Sure. I mean, Bitcoin, look, let me say, first of all, I can't prove what I'm about to say because we don't have enough history. But I do think that Bitcoin, because of its limited supply and its ability to survive a lot of tests, appeals to gold investors. And I can tell you, I've spoken with hundreds of our gold clients, and they've also invested in Bitcoin. So I think I have some evidence that the mental model for Bitcoin to be a store of value against paper money is true in the minds of a lot of investors. But you're right, Julia, there's a lot of other dimensions of what's going on in the blockchain or cryptocurrency world. Ethereum is probably the large cap stock, if you will, of that blockchain world. And the believers in it think that this database technology can really lower costs for consumers in the financial payments and security settlement area, and obviously also compete directly with IT and software companies, because Ethereum is a database, just like Oracle is a database company. So that's the premise. I guess our view from an investment perspective is there's a reasonably good chance that some value gets created out of this technology, and so you want to have it part of your growth portfolio.
Yeah. Like have some sort of exposure to it. And I'm kind of like sensing like, maybe I wonder, given the FTX situation, I don't know the level of Bitcoin right now. It's probably, I don't know, 16 or something and change. I just wonder like it sounds like there's still confidence in it. It's not going anywhere, at least not right now.
We'll see. I think we'll see. A lot of people, there's a lot of talent, a lot of talented developers in California and globally that have changed their careers and started developing software using Ethereum and other kind of database technologies. Let's keep it general. So we'll see if that talent continues to go there. We know that a lot of capital is going there. The amount of money allocated to crypto or blockchain venture capital funds last year, I think it was like 50 billion. It's a huge number. So the capital is there, the talent is there. We just need to see some of these software applications, I think, more usable for the average person. And that's what's called Web3, and we're just not there yet. So we'll see if we get there.
Yeah, we'll see if we get there. We've talked a lot in this conversation. We've talked about a lot of different areas in this conversation, whether it was, kind of the macro picture, the Fed, inflation, of course, digital assets as well. And, as we start to round it out here, just kind of wondering, like, what are the kind of big risks that you kind of think about, or what are the things that kind of keep you up, things that are in the back of your mind, maybe in the year ahead? Like, what are those risks for you today?
I don't mean this in a risk area, but if you think of big multi-year trends besides the energy transition that I talked about, another one is going to be the trajectory of China's economy. China was a huge driver, like China or not. Like, you don't have to, you just have to know its effect on the economy, because it and the United States were the two biggest drivers of global growth by a mile over the last 20 years. And China's economy is just going to be traveling at a slower trajectory. I like to say, like, think about 2 or 3% GDP growth. And part of that is their demographics. Over the next 80 years, their population is actually going to shrink from 1.4 billion to 800 million. They're about to go through their labor force probably peaked last year, so their population is going through sort of what Japan is. And so I just think investors should have that framework. Will Indonesia and India and Brazil maybe pick up the growth, or Africa? We don't know. But that's part of the big ingredients to, investors, is where's growth coming from? Because growth can drive profits. So that would be the thing that I would highlight looking at forward.
Yeah, a slowdown, and also the demographic story. Like I don't know, like how one might think about, like how would that play out? Like how would that, hypothetically, like how does that kind of transpire?
I think equity portfolio managers are already doing this, but what do you don't want to own baby diaper companies. You want to own adult diaper companies, right? You want to have healthcare as a healthy part of your portfolio. So you just kind of shift, I think where your equity exposure is. I think the markets kind of do that naturally, but I think that's what you want to keep in mind. It's just it's such a big, important structural trend that I think it's worth pointing out.
Yeah. Well, we've talked again about opportunities that you see. I know there's some opportunities in fixed income, the risks. Any parting thoughts for the folks listening, or is there anything that we didn't bring up that you're kind of keen to talk about?
Yeah, I would just summarize, right? This has been there's three big drivers on financial markets. There's is your central bank printing money? Is your government, your central government spending money? And how's the economy doing, right? And so all three were kind of negative for investors this year. The Fed absolutely stopped printing money. Money supply growth is zero or slightly negative right now, and you have quantitative tightening. I think with the split in Congress, now that we know, but it was probably projected, you're not going to see a lot of government spending. Even Larry Summers and leaders of the Democratic Party don't think that we should be spending a lot of money, because it just keeps driving inflation up. And the world economy is going to be in a slow growth phase next year, because Europe is certainly in a recession, and China is only starting to regain some momentum. So all of that is to say, don't sit in cash. There's a lot of damage that's been done, and own bonds if you're scared, but just don't stay in cash, because ultimately the price of staying in cash is really the worst for investors and savers.
Is that just because of the inflation eating away at the cash that you're just holding on to?
Yeah, look, in financial markets, you generally get over time 8% a year, right? And in the bank, what do you get? 1 or 2% a year. That is such a dramatic difference. We focus on all the wiggles, but that is just being in the market. And what I saw a lot after the financial crisis, I don't know if you experienced this, but people were just so shell-shocked, they became too conservative at the wrong time. So they were in this super conservative fixed income stuff, and they gave up so much return. And so that's my concern, for investors going into the new year.
Yeah, I imagine there's probably a lot of psychology in it too, like making one get too conservative.
Very simple. That is, oh God, you just hit my thought, my hot button. That is why I think a history and the reminder of how things can change, because recency bias. We are so focused on even our regulations make us do it, focused on our track records the last 12 months, when the next 12 months can be entirely different. And so we need tricks as investors to offset that recency bias 100%.
Wait, how do you do that? Yeah. What are the tricks?
Well, I think you hire a financial advisor who yells at you every time you want to go to cash, right? Literally, it's worth it, to get that advice. So, things like that. A spouse,
yeah.
A friend, right? Stay invested. Reread a book, right? Stay in equities. So, so that's kind of my that absolutely recency bias, I think, is Michael Lewis has written some great books on and others, right, on psychology and investing, but that's the biggest cause of misallocation, I think.
That is so fascinating. Maybe we just kind of get in our own heads and recency bias. Jan, really interesting conversation. I feel like I took a ton of notes, because I feel like I learned a ton from you, especially on fixed income. Where can folks go to learn more? Maybe, where can they follow you on social media? Where can they find you or learn more about, your firm, your funds? So I'll just pass it back to you.
Yeah, I mean, our firm website is vaneck.com, VANECK.com. But I'm on Twitter, Jan VanEck, number 3, and also I'm on LinkedIn. You'll love this. I post my favorite podcast episodes. I learn so much through podcasts. It's like such a treat to listen.
Okay, what are your favorites?
Well, my 2 that I feel like I enjoy every week, because some of them, change around in terms of episodes. But I think the All In podcast, it's a little bro-ish, but
I love the All In pod. I love
such a good job of summarizing the public markets, the private markets, and then I love Friedberg's technology stuff.
Yeah.
And then for crypto, there's one out of Blockworks called Empire, which I think has just got amazing, insights on a regular basis. If you have to, summarize it to one. So those are just my go-tos, but I probably have like 50 that I track.
I love it. Well, I had Dave Friedberg, Sultan of Science, on for a long extended science corner on this podcast. So for folks, I don't know, he's my favorite bestie. I don't know if you have a favorite bestie, but definitely mine.
I was psyched to be on a Zoom with him a couple of weeks ago. And ag, which he's really into, ag tech, is very much part of what I was talking about in terms of energy transition. He's great, and there's a lot of exciting stuff that he's doing. And
is that part? Are y'all are expressing like that is part of like a realm of like being able to invest in that area? Is that something y'all are doing?
Yeah, well, we have the biggest ag ETF, ticker symbol MOO, MOO.
Love it.
And then we have a much smaller ag tech ETF. And we do a lot of research in the private area as well.
Really cool. I really enjoyed having you on, Jan VanEck, CEO of VanEck Funds. So great to talk to you. Thank you so much for joining us today.
Thank you.